My name is Fred Murimi. I'm the managing partner of Centum Capital Partners. So CCAP, which is Centum Capital Partners, is the private equity arm of Centum Investment Company Plc. So we have been investing in private equity since Centum began 52 years ago, and that's what we've been doing. The private equity class is where we're looking to invest into the equity of private companies as opposed to publicly listed companies. So for CCAP, like I mentioned, we've been investing in private equity, or what is today known as private equity, since 1967. We've been fairly active. If I look back at the last 10 years of Centum Capital Partners, we've possibly been one of the most active private equity managers in this region. We've had 15 investments over the last 10 years. So far, of those investments that we've made over the 15 years, we have been able to exit 10 or realize our investment in 10 out of the 15. In that process, we have also returned quite a bit of capital back to Centum. Over the 15 years, Centum has been able to invest about 13 billion shillings into the private equity portfolio. To date, we have been able to return back to Centum from the original 13 billion shillings. We have been able to return back to Centum almost 48 billion shillings in the last 10 years, and still have a remaining portfolio value of roughly about 7 billion shillings. So in the last 10 years, total return to Centum has been 4 times the original 13 billion shillings investment. So Almasi is one of the private equity companies that we have been invested in for a long time. It was actually the formation of 3 Coca-Cola bottling companies that we had been invested in, that is Mount Kenya Bottlers, Rift Valley Bottlers, and Kisii Bottlers. So back in 2012, we as a shareholder, common shareholder in the 3 bottling companies, thought it would make economic sense to consolidate the 3 bottling companies. We had analyzed each of the 3. We had seen opportunity to grow the respective businesses, to grow from a common platform, but also make rational investments across on a shared basis on the 3, and also bring in a strong management team within the 3 bottlers. So that's a journey that we began in 2012. We had to do quite a bit of work convincing the other shareholders in the 3 bottling companies on the case for merging the 3 bottling companies. Some readily accepted, others took longer on that journey, but we set off. So back in 2013, when we then effected the merger, Centum had about a 30% share of Almasi. Over time, we then increased our shareholding in Almasi to a controlling stake of 53%. The case that we saw, like I mentioned, we see opportunity to enhance revenue. The enhancement of revenue was going to come primarily from being able to expand capacity of the 3 bottling companies. We saw opportunity to also improve margins in the business. So if I take the example of the PET bottles, that's the plastic bottles, we were within the 3 bottlers, each of them was buying from different bottlers outside of the 3 bottlers, and the margin that we were making was quite thin. So we took the decision, which was part of the case for merging the 3 bottlers, we took the decision to invest in our own line. That decision moved the margins from something like 16% to almost 45%. We also saw opportunity to invest in our own distribution. So if you think of the long distances that Almasi territory covered, because we're distributing in 24 out of the 47 counties of Kenya, and the bulk of it was being transported using hired transporters. which was at times unreliable, so we made the decision to invest in our own fleet. That improved the turnaround of the delivery of the soda. Even the farthest distance was covered within 24 hours, which is important because if you think of the consumer, if I go to a kiosk and don't get my soda today, tomorrow if I get it, I will not drink two because yesterday I didn't get soda. So soda has to be available all the time, every time. So the investment in distribution was very important. Investment in people as well was critical. People both at the management level and also at the board level. So at the people, we were able to promote one of the managers of one of the plants to become the CEO. The lady was very well versed with the system and able to empower, strengthen and create a strong leadership team at the top. And that saw them increasing performance, volumes went up significantly. We were able to then now support them with the investment program that we had already identified. At the board level, we also then rationalized, created one board for all the three companies so that there was unity of purpose and a shared sense of value as well. So there was quite a number of touch points that we had for us in the journey of creating Almasi. The overall effect, which is what we pursue as private equity managers, we pursue capital appreciation. So back in 2012, when we merged the businesses, they had a combined value of about 3 billion shillings. In 7 years, we were able to grow that value from 3 billion shillings to 20 billion shillings. So an additional 17 billion shillings of value was created over a 7-year period. So we are quite proud of that journey. We have recently exited Almasi to a new investor. This new investor, I think, was pleased with the performance of the business. They've been able to see the benefit of creating one platform, that is Almasi today, with a strong management team, with a strong board. And so they're then able to come in and now take the next phase of growth in the business. Great. So for us, we have 5 touch points when you speak about value creation. So any business that we analyze, we see if we apply any of those or all of those 5 touch points, we then quantify what is the possible value that could be created. The 5 touch points are: number 1 is the opportunity to enhance revenue. If I go back to the case of Almasi, the revenue enhancement came primarily from being able to increase capacity, production capacity, but also increase distribution capacity. Because it's one thing to have the production capacity, but if you're not getting a product out, then it doesn't translate to sales. The second is to then improve margins. The margins will come as a consequence of how much you're actually producing, but also are there opportunities to reduce costs. So for instance, in the case of Almasi, by creating one management team, one platform for distribution, also rationalizing where we do the production, we were then able to save certain costs, which improved the margins of the business. So if I look at the EBITDA margins, that's a common term in our world of private equity, the earnings before interest, tax, depreciation and amortization. In 2012, the EBITDA margin was 10%. So for every 100 million shillings we were earning, for every 100 million shillings of sales, we were earning 10 million shillings in EBITDA. We then moved the EBITDA margin from 10%, that was in 2012. By 2018, the EBITDA margin had grown to 28%, which means from the same 100 million shillings of sales, we are now making 28 million shillings, up from the 10 million shillings that we were making in 2012, which came again from just the benefits of the merger, rationalization, and the efficiencies. The third is being able to deploy capital more efficiently. And the capital deployment could be in the form of expanded production capacities. It could also be in the form of new equity coming into the business to support the expansion program. It could also be, as far as debt funding is concerned, being able to source debt cheaper. And for us, because we have a network of financiers that we work with, we're able to source debt cheaper than a number of standalone businesses could. Okay, so if you're able to save on interest expense, that already is another way of creating value for the business. The fourth then is on corporate governance. And on corporate governance, what we do is to strengthen the institutions, operations, processes, policies, and people. Okay, so what we are looking at there is, are we able to bring in a stronger management team? Are we able to refine the processes? Are we also able to reduce areas of wastage or pilferage as well? Because if you're able to save 10 shillings every day, for instance, just by reducing pilferage, wastage, and the like, that's a lot of value that is being created. Then the last is to reduce risk. Risk could be internal, could be external. If I look at external risk comes from regulation, from tax, from the legal environment. And because we have a very broad network of contacts that we have formed over the 50 years that Centum has been around, we are then able to work with the businesses to manage the external risks that could be posed to a business. So in any business that we are looking at, even in the case of Almasi, for instance, we worked with them to be able to manage just some of the tax exposures, to be able to manage some of the regulatory exposures that were coming through. So that's what we look at. So in any business, we go in and look at, of these 5 touch points for creating value, are we able to create value? So the value creation is almost a second step. The first step is this a company that we even want to spend time looking at? Okay, and what we look for in that first step is we look primarily for companies that are market leaders in their respective segments, which means they've already won with their customers. So if I go back to Almasi, for instance, in the territories that it was distributing product to, Coca-Cola had an over 90% market share. So already it was a market leader. We then look at, is there a competitive edge that this business has, which is not easily replicated by other businesses. Once those first two are met, and then the third one is then also, will this company be strengthened by having Centum as an investor in the business? Because there could be a market leader, but if we come in because of either our corporate governance practices, our style of leadership, we might actually make the company less competitive in the market. Okay, so once we clear through that first step, that's now when we spend more time analyzing what is a value creation strategy that we can then deploy into each company. So for us at Centum as an investment company, because we know one day eventually we are going to exit that business, our parenting model is to make the companies independent and strengthen them at their level and not to be Centum reliant. Because if they are Centum reliant, at the point that we want to exit, that one day we'll not be able to exit because the company relies on Centum. So we look at strengthening the management of those companies. We look at strengthening the boards of those companies. We look at strengthening the processes of those companies, but in ways that speaks to their industry. So at Centum, we are investment people, which is a very different skill set from selling soda. So we look and see what is the best management, what is the best governance that is applicable to the sale of soda. And that's how we then empower those companies. So it's not reliant on Centum. What we do is just to ensure that the governance processes are world-class. That if it is a training, that they're getting exposure to world-class training that is relevant to the industry that they are in. If it is processes and systems, if the best standard is, say, an ISO standard, we then get those companies to adopt those standards relevant to their industry. So we don't necessarily want to take a Centum way of doing things. What we identify is what are the value creation points, what kind of processes, people, systems do we require to be able to unlock that value, but especially what is relevant to that industry. And the parenting style for us is to make the companies independent of Centum. Of course, the biggest impact that one can have as an investor is on creating and sustaining jobs. And I think in all the companies that we've been in, we can clearly see how jobs have been created and sustained. And I think that's really the biggest impact, number one. Then secondly is then how do we strengthen them to be the best they can be in their respective jobs, their respective industries. So we really support a lot of training programs at board level, ensuring that training budgets are sufficient as well, so that the people can be best in their class. Okay. I think the third area looking at impact generally is then also we think about then the indirect jobs. Okay. So if I take for instance in the case of Almasi, we increased the number of distributors almost 3 times that we had. The number of outlets where our products were available increased almost 4 times. I think from something like 10,000 to 40,000 outlets where we were available. So if you again quantify the impact of the indirect jobs that we are creating by ensuring that we are running an efficient company where we are invested in, of course has a lot more impact. In some cases we are then able to even look at special interest groups. If you think of, say, for instance, with the case of Almasi, what we're able to then do is then create a program where we support women entrepreneurs to be able to set up distributorship businesses. And we then even leveraged on another business within the group, that's a bank, where we're then able to support them with financing as well. So it's meeting a business need where we need more distributors, but it's also then a targeted special interest groups. Almasi is a company that we're very proud of. The name Almasi is Swahili for diamond. Many times before the diamond has gone through the refining process to what it is, the jewel that you see, it's as a raw metal, it's one that you'd ignore because it's full of impurities, not shiny in any way. And to some extent you can say that prior to the merger of the 3 bottling companies, in some way they had a lot of impurities and imperfections in them. However, through this value creation, which is akin to a refining process to create the diamond, we then have the diamond that is Almasi today. There's many companies like that today in Kenya, in East Africa, speaking generally, where the original owners, the management have done a fantastic job in growing market share, have a competitive advantage, have built a good business. However, there may be certain inefficiencies or constraints in the businesses, and the inefficiencies or constraints could come from either lack of capital, lack of clear processes, maybe poor governance structures, which are constraining those businesses from moving from a good company to a great company. So my work every day is to keep looking for good companies and then identifying what we need to do to make them great. And there's many such companies that we are seeing, and we now have the capital to deploy into such companies. In fact, we are seeing opportunities that exceed the capital that we have today. So for us, primarily we are driven by return. And for us, we then look at seeing this return that we could possibly create in terms of value. How will this then be shared? Because we don't want to scoop everything for ourselves. If I go back to the Almasi example, where we created an additional 17 billion shillings in value, from 3 billion to 20 billion, then this additional value was shared with other shareholders. Even the employees had a share of that. I remember in 2018, I think we paid them the highest bonus ever of 200 million shillings. So even the employees gained from this value that is being created. So for us, our ethos is about sharing value, creation and sharing of value. But also importantly, in that journey, we then have to be responsible investors. And responsible for us is the environment, the society, and also from a governance point of view, what is now commonly referred to as ESG. So we want to ensure that we are responsible across those 3 verticals. If you look at how we were able to grow value from 3 billion to 20 billion in a period of 7 years, that's almost a 7 times growth over that period. And that growth, a big chunk of it has come from what we spoke about, constraints or inefficiencies in the business. So for us, once we've taken a company from good to great, the likelihood that you can then take a great company to, I don't know whether it would be double great, super great, over a 7-year period and get another 7 times the return is lower. So for us, once we get a company from good to great, we then now cash in on that return that we've been able to generate, and then now use that capital to look for other good companies that we can then now take through the same curve of getting a company from good to great. It may be 4 times, 5 times, 7 times growth that we then again see. But once you've taken a company to a great level, then the kind of return that an investor can expect, because now it's much lower risk, we fully optimized the business, the return is there, but will be sort of smoothed out. For us, we're looking for astronomical growth. We're looking for huge capital returns, which is why we keep looking for good companies that we can create into great. If I put numbers to it also, I think the second reason for us to have exited, our share in Almasi was about 11 billion shillings in terms of value that we were able to exit. We were then being paid, because we are not very aggressive on capital, on dividends. The dividends that we were earning was maybe about 250 million shillings from that investment, which is almost a 2% cash return. Okay. Meanwhile, for Centum, we had certain borrowings that we had taken to be able to fund this growth. Now, those borrowings were being charged 12-13%, which means on that value of 11 billion shillings, we're incurring a finance cost of about maybe 1.5 billion shillings compared to the 250 million shillings of dividends that we were earning. But it was logical to do so because of the value appreciation that we were chasing. So once that is achieved, then we took the cash and then we were able to settle the debt obligations, which has then now freed up effectively from a 1.5 billion shilling cost. That has come down to almost zero. We are sector agnostic. We can look at almost any sector, which allows us to invest responsibly. But then the next level for us is then looking at company-specific opportunities and whether there's opportunity for us to grow our business value 3, 4, 5, 7 times. That is what primarily drives us. Are we able to invest responsibly into that sector, and are we able to grow value? So that said, we are open to looking at almost any business, any sector, provided this particular company shows market leadership, a competitive advantage. Then we are happy to look at the business, see whether we can add value, are we the right partners to add value, and then we invest. We have an investment strategy that has worked. We've demonstrated that it works. We've demonstrated that if we're able to touch on any of these levers of the value creation, we're actually able to create the value. And over the last 10 years, we've been able to generate a 25% annualized return on the investment. And that primarily has been investing Centum's money. Right now, where we are today, we see opportunities to do the same thing we've been doing, looking at companies, deploying capital, touching on those 5 levels of value creation and creating a lot more value. In fact, we are seeing opportunities that exceed Centum's own capital that it's looking to deploy. And Centum is looking to deploy in excess of 10 billion shillings over the next 5-10 years. So for us, we are now looking through our private equity fund structure to then work with other investors where they put in the money into the private equity fund, and then now we keep doing the same thing we've been doing, deploying capital into market leaders, optimizing those companies, exiting, and giving a return back to the investors.